Most people understand what a bank is. We know that to manage our money wisely, it's essential to have both a checking and savings account. If you have $1,000 you won't use for a year or need to borrow $100,000 for 30 years, finding the right person to help can be tough. It's hard to locate someone who needs exactly $1,000 for a year or has $100,000 to lend for 30 years on your own. That's when banks step in. They bring together people who want to save or borrow money, making it easier for you to achieve your financial goals. Do you want to know more? Just keep watching. The origin and evolution of banking is a fascinating journey through history. In its historical background, banking traces its roots to ancient civilizations, where early banking practices involved the safekeeping of valuable items and deposits of grain and precious metals. These rudimentary systems gradually evolved into more sophisticated financial services, with the emergence of modern banking institutions such as the Medici Bank in the 15th century and the Bank of England in the 17th century, which introduced concepts of lending, credit, and central banking. In the present, we witness a significant transition from traditional to digital banking, driven by technological advancements and changing consumer preferences. Today, people can access their accounts, make transactions, and apply for loans from the convenience of their smartphones, marking a profound shift in the banking landscape and the way financial services are delivered. Banks have a big job, but their main job is to collect money from people who have some to spare, like you or me, and then they mix all that money together. Thereafter, they give that mixed-up money to people who really need it, like when you want to buy a home or start a business. Think of banks as the middle people between those who save money with them and those who would like to borrow money from them. The extra money they pay to people who save with them and the money they make from lending it out are both called interest. The people who save money with banks can be regular people, big companies, or even government groups. The ones who want to borrow money are just like them. Occasionally, the saved money can be taken out anytime you want, like in a checking account. Other times, there are rules on when you can get your money out, like in a savings account or a fixed-time deposit. Moreover, banks significantly contribute to money creation and circulation in the economy through various lending and credit activities which stimulate economic growth and development. Besides this, they serve as trustworthy custodians for people's assets, offering secure safekeeping and effective wealth management solutions. By offering services like savings accounts, investment options, and financial advice, banks assist individuals and businesses in preserving and growing their wealth. In the universe of banking institutions, several distinct categories exist, each serving diverse financial functions. Commercial banks are perhaps the most familiar to the public. These institutions cater to individuals, businesses, and organizations by accepting deposits and offering various financial services, such as savings and checking accounts, loans, and mortgages. Investment banks, on the other hand, specialize in capital markets and provide services like underwriting and facilitating mergers and acquisitions. Their primary role is to assist companies in raising capital by issuing stocks and bonds. Central banks play a pivotal role in a country's monetary system. They control a nation's money supply, implement monetary policies, and act as lenders of last resort during financial crises. Before we delve deeper into the world of banking, make sure to subscribe to our channel for more valuable insights and updates on finance and beyond. Online and digital banks represent a relatively modern addition to the banking landscape. These institutions operate primarily through digital platforms, providing customers with convenient, technology-driven banking services, often with lower fees and competitive interest rates. They've gained popularity for their accessibility and user-friendly interfaces, making them a compelling choice for those who prefer to manage their finances in the virtual world. These diverse banking institutions collectively form the backbone of the financial sector, offering a wide array of services to meet the unique needs of individuals and businesses in an ever-evolving financial landscape. So, the banking ecosystem is a complex web of interconnected elements that play pivotal roles in shaping the financial landscape. Regulatory bodies act as guardians of the financial realm, responsible for ensuring that banks operate fairly, transparently, and in adherence to established rules. They monitor and enforce regulations, safeguarding the interests of both customers and the broader economy. Banking services and products constitute the lifeblood of this ecosystem, offering a wide array of financial tools such as savings accounts, loans, and investment opportunities. These services empower individuals and businesses to manage and grow their wealth, thus underpinning economic progress. Technological innovations have wrought transformative changes within this ecosystem. The adoption of digital technology, fintech solutions, and blockchain has streamlined operations, making banking services more accessible, efficient, and secure. Moreover, it has fostered the emergence of online banking, mobile payment platforms, and cryptocurrencies, revolutionizing the way people interact with their finances. This technological renaissance is driving an evolution in customer expectations and service delivery, fundamentally reshaping the banking landscape. Moving towards the mystery of interest encompasses a multifaceted exploration. Interest, in its essence, refers to the extra money paid for borrowing or saving funds, and it comes in various forms, such as simple and compound interest. Banks, as financial intermediaries, wield the power of interest rates to regulate the flow of money. They entice depositors by offering interest on savings accounts, while borrowers must repay the principal amount along with interest. This dynamic allows banks to harness the funds deposited by individuals, businesses, and governments and lend them out to those in need. The crux of the matter lies in how banks judiciously manage these interest rates. When banks adjust their interest rates, it creates a ripple effect on the broader economy. Higher interest rates tend to curtail borrowing and encourage saving, affecting consumer spending and investment. Conversely, lower interest rates promote borrowing and spending, which can stimulate economic growth. Moving on to deposits and borrowing, there are several key aspects to consider. First, let's explore the different types of deposits. Banks offer various deposit options, from easily accessible checking accounts to those with certain restrictions like savings and time deposits. Next, we delve into the borrowing process and credit evaluation. When you require funds, banks act as intermediaries, assessing your creditworthiness before lending. This involves looking at your financial history and ability to repay. Lastly, we'll discuss the risks and benefits of borrowing from banks. Borrowing from a bank provides access to capital, which can be essential for various purposes like starting a business or buying a home. However, it also carries the risk of accumulating debt and interest payments. Understanding these aspects of deposits and borrowing is vital for making informed financial decisions. So, how do banks around the world influence the global landscape? Banks have an important job in helping the government control the country's money. They work closely with the central bank, which is like the boss of all banks. The central bank can make there be more or less money in the country by changing rules for banks and doing deals with them. When banks have less money to give out, it can become harder for people and businesses to borrow money, and that can be a problem for the economy. Banks can also have some big problems themselves, and it's not just their problem. It can hurt many other people and even the whole economy. When a bank fails, it can mean that people can't get their money out, loans can't be paid back, and businesses may struggle to pay their employees or suppliers. Sometimes one bank failing can cause a chain reaction, leading to more banks failing, which is awful for everyone. Wondering why bank safety and security is such a big deal? Let's find out. In many countries, banks need special permission, a charter, to do their banking stuff and get support from the government if things go wrong. This support includes emergency money from the central bank and guarantees for your savings up to a certain amount. Banks have rules to follow, and people check up on them regularly to make sure they're doing things right. If a bank has branches in other countries, they have to follow rules there too. These rules are like safety measures to make sure banks don't take too many risks with your money. They need to have enough good quality money saved up in case things go wrong. Big global banks require even more money to make sure if they have problems they don't mess up the whole world's money, called systemic risk. There are also rules about how much ready cash they need and where they get their money from to keep things stable and safe. In a nutshell, banks play a pivotal role in our world, serving as financial intermediaries between savers and borrowers. The banking landscape is continuously evolving, with ongoing mysteries and transformative changes. Looking ahead, the future of banking remains significant, adapting to the needs of our dynamic world. So, don't forget to subscribe to our channel for more insights into the ever-changing world of finance and beyond.